I'd say we're cautiously optimistic on the outlook for Australian equities. So in Australia, we're starting to see signs of consumers trading down, retail sales slowing, and delinquencies rising. Unemployment remains near record lows, but this could be starting to change. For example, Telstra just announced that it was laying off 2,800 staff, which marks the first large-scale program of redundancies by a major Australian corporate since COVID. I guess all of this tells us that the economy is not exactly running red hot at the moment. And we think that this risk is not currently being contemplated by the stock markets, given valuations are still near all-time highs. So why is the stock market so hot? We think that it's in part due to the rise of things like momentum-based investing, which is essentially when the market latches onto a theme and drives stocks associated with that theme higher and higher without regard for the fundamentals. We're starting to see this play out in the Aussie banks at the moment, as well as in stocks exposed to AI, such as NextDC. The problem, however, with this style of investing is that the trend is your friend until it's not. And when the herd changes its mind, things can actually move against you very quickly. We look at things a little bit differently. We are less focused on what will happen in the next 6 months and more interested in whether a stock has real sustainable competitive advantage, because we think that investing in these types of companies is the best way to generate and compound our clients' wealth over the long term. I'd also note that while Australian equities have gone up along with the US market, our valuations don't look quite as stretched, so we think there is scope still for relative outperformance. I'd say the 3 key things investors should keep in mind is, firstly, to be aware of the most but not all the banks. Secondly, to consider differentiated ways to play emerging themes. And lastly, to take advantage when the market has fallen out of love with a stock for short-term reasons. So firstly, on the banks, earnings expectations for the banks have barely moved in the last 12 months, yet their share prices are up 30 to 40%. We think that this re-rating is unjustified in light of their poor earnings outlooks. As an example, let's take CBA. CBA is the largest bank in Australia. It's so large that 2 out of every 3 Australians bank with them. So this makes them the most exposed to a downturn in the cyclical housing market in Australia. And yet its valuation is at all-time highs. It's actually the most expensive bank in Australia, and not just in Australia, but in the entire world. We think there's much better places to put your money. For example, into Macquarie Bank, which is, it offers a similarly cyclical banking exposure, but it's trading on a much lower valuation, and it's much more diversified and has higher earnings growth. Secondly, I'd say investors should consider differentiated ways to gain exposure to emerging themes. So we're very excited about the prospects for AI, like most people are. But we think that the associated hype has driven some stocks to extreme and unjustified levels. We would rather play the AI story through second-order beneficiaries like copper. So copper is a crucial raw material that's used in the build-out of data centers. And in fact, you need so much of it that we think there's likely to be a shortage in the next 2 to 3 years. So that's going to be beneficial for the copper price. And at the moment in our portfolios, we have exposure to copper through BHP and Evolution Mining. In the case of Evolution, it's not just a gold company. In fact, 30% of its portfolio is in copper, and the share price is down 7% this calendar year to date. So we think it's a better way to gain exposure to AI. And lastly, the market doesn't always get it right. And investors can do well by stepping in when the markets are fearful for short-term reasons. So an example of this is in IDP Education. IDP is an English language testing and international student placement business. They've been around for over 50 years. But the stock's actually lost a third of its value in the last 12 months. And that's on the back of concerns around the impact of government policies on immigration all around the world. But we actually think that a cleanup of the testing industry would be positive for someone like IDP because it would weed out some of their less credible competitors and also increase language testing standards. So we see a lot of upside for that stock from here. Our philosophy is that we take an active approach in backing high quality companies that we think have a reason to exist in 10 years' time. Now, currently, the market is overlooking some of these types of companies in favour of growth stocks that have little to show by way of earnings or free cash flow. And we think that this dynamic is unlikely to continue forever.